Well, hello, everyone, and welcome back to Risk. I'm Lee, and I'm fortunate enough today to have Mr. Gareth Soloway, market technician and trader extraordinaire. Hello, Gareth. How you doing, man?
Hey Lee, I'm doing really well. How are you?
I'm doing well. So why don't you give us a quick 5-minute overview of what you see in the markets right now? What's going to go up? What's going to go down? What's your feel on everything?
Yeah, so I think the biggest news right in the last month or two is the Fed tapering and tapering faster than initially thought. And then really lately, we even heard that they'll likely be raising interest rates in 2022 as well as drawing down their balance sheet. So those factors, if you look at what drove the market up since the COVID collapse of March 2020, it was just money being thrown at the markets, whether it was from the government, whether it was from the Fed, it was just so much money. And now we're entering a phase where because of inflation, they have to draw that down pretty quickly. So if we go to the charts, you can actually start seeing it in the charts already, which is pretty cool, right? So you can see this is the channel that the S&P has been in since basically March of 2020, right? You had the big dip here, right here, and then after that, you started this upward climb within these two parallel lines. What you can see here is really cool, right? So you hit the line here, you hit it over here, and you hit it over here. Look at how much distance there is. That was telling you that the market was strong between every time it hit that lower trend line. And if you look at the highs, it was all along this high end right here. It tagged it here. It tagged it here. And then look at what happened recently, right? All of a sudden, you get further and further away from that upsloping line, and you start hitting the line more and more and more times. And what's that telling you is that as the Fed is drawing down their QE, essentially, the markets are starting to turn. And I do think that based on the price action, based on the charts, we're looking at a potential breakdown below this channel and really a potential pretty big correction in the S&P over the next 1 to 2 quarters in the market. So again, that's kind of the position I'm in. I think inflation is going to be, not as, we know it's not transitory anymore. I was saying that for years, well, not years, but for the last year. And then the Fed kind of finally came around. But I do think it's going to stick around longer than people think. And it's going to force the Fed to be definitely more aggressive to try to get inflation under control until, and this is the key, until their tactics start to hurt employment and you see the unemployment rate rise, and then they're going to start to back off. But until then, they're all about getting inflation under control. So, just to, give you an overview of markets, I think, again, technology will be the one that suffers the most in the near term. We've already seen that. And I think that, again, value names like dividend payers, Viacom, Discovery, those type of names that haven't performed well, they'll probably be the safest areas to be. Plus, honestly, foreign stocks. I'm a big fan of foreign names right now out there.
Are you looking at ADRs, or you're looking in other exchanges globally?
Yeah, I mean, I think ADRs and ETFs. So you can go to like a KWeb for China exposure, or you can go to Alibaba or Baidu. I think that based on how much those have declined and the valuation and the potential growth for those names, even with the regulatory crackdowns in China, make those the place to go. Remember that when the Fed started pumping money in, everyone from around the globe flooded to our markets, right? So there's an over, existence of capital from foreign countries in our markets. I think as the Fed begins to tighten, those people are going to start to pull their money out and look for better opportunities, right? So I think, again, Brazil, South America in general, China is an interesting one for me. So those type of places, I think, are definitely a place where you can still get some good returns, even in a tough U.S. market environment.
Well, what about the other BRIC countries like Russia and India?
Yeah, so I think Russia is a tricky one, right? Because I think that overall there's some great opportunities there, but you also just have to kind of keep an eye on the Russian troop buildup on the Ukraine border. Obviously, if something escalated there, that could be very detrimental to investments in Russia, especially if more sanctions are put on and stuff like that. So I think Russia is a place where if things calm down, there's a huge opportunity. But for me, I'm not a risk taker enough to jump in there at this point. But I think India is great. I mean, a lot of these kind of pseudo emerging and now, sophisticated economies are definitely places where you can find some sort of good return.
What about bonds? What's your take on those?
Yeah, so I'm in the position where I think the Fed obviously is attacking inflation, so that's generally going to be more hawkish, good for interest rates rising. But I don't see interest rates going up that much more. Right, we're right around 1.75, 1.8% on the 10-year. I think this year you'll hit 2 to 2.25%, and I honestly don't see interest rates going higher than that. So yes, there's some further upside in yields, but I do think that as the Fed puts pressure to get inflation under control, you're going to have a deteriorating US economy. And then as soon, again, their dual mandate says they have to pay attention to unemployment. So as soon as those tactics start to hurt the economy and you say layoffs, maybe the unemployment rate goes to 5, 6, 7%, they are going to very quickly back off. And they're going to use the aspect of their dual mandate and saying, okay, well, yes, inflation is still at 5 or 6%, but we have to make sure that we monitor unemployment here as well. And then I think that really puts a short-term cap on interest rates continuing to rise, at least for the next year or two.
That makes sense. So how are you playing the equity markets? I mean, are you looking for short opportunities in this environment? Are you still going long on pullbacks?
Yeah. So as a swing trader, I'm definitely looking at some long opportunities and beaten down names. So we can just go over a few of them. And this is what's remarkable about the market is that in this market environment, you've had certain stocks that have just gotten absolutely annihilated. So a good quality name that I've been bottom fishing a little on here is Square. And you can see there's a definite good little area of support here. The stock is almost straight down from $275 to $130 on Friday. Got a little bounce into the end of the day. I ultimately do think it's going to go lower down to this kind of 85 area down here. But I think in the near term, you get a bounce first, maybe back to 170 or so 150 to 170. So as a swing trader, that percentage is too lucrative for me not to take advantage of, and before it makes its next move to the downside. And there's some other names out there as well, like if you look at FSLY, I mean, some of these stocks have been annihilated where this was trading north of 130 in 2020, and it's now a $30 stock. AI, an artificial intelligence stock, IPO'd in late 2020, ran up to 180 and is now at $28. So I think that if you're a shorter term trader, there are opportunities here where you can get involved in some of these names. But again, it's not, just understand it's not for a long-term trade, as I do worry that deleveraging will eventually force these stocks to go lower.
So you're looking at maybe a 1 to 2 week time frame here?
Yeah, that's really what I am. You get 10 to 15% upside, and I'm probably taking money off the table. Maybe I'll leave a little bit on the table just as kind of a lottery play, just in case they continue up, but certainly paring back the position by at least half. And then the long area. So in general, I'm short the equity market. So I'm short the NASDAQ 100. I'm short the S&P right now. I'm not short the Russell at this time, but I'm keeping a close eye on it. But then you have the long position. So it's basically like a long short portfolio where again, short the markets, but then long specific stocks that have been beaten down, long some of the Chinese stocks for sure, and names like that.
So what's your take on precious metals in this environment?
Yeah, so precious metals, I just continue to be so bullish on. I mean, if you look at the gold chart, and I'll bring that up for you guys, the gold chart continues to be in this beautiful wedge pattern, right? And it's the wedge pattern is forming off of a larger move here from 2018 that topped out in 2000 and late 2020. So if you look at the magnitude of that move up, it shouldn't be surprising that gold has not done anything for the last year or so, because it had to digest that massive move up. Remember, we went from 1,150 all the way to 20 and a half or so, $2,500. So it was almost a double in gold. And it then had to kind of consolidate. Think about a marathon runner, right? You run a marathon, or someone runs a marathon. They can't run another marathon the second they finish that first one. They have to refuel, they have to rest, and then they can make that next move up. So that's kind of what I'm thinking gold's doing here. Based on history, 1975 to 1985, that early period of inflation from 75 to 78, gold really did nothing, even with high inflation. And then it just ripped in that second portion. So I think that's kind of what's going on here, where once gold breaks out over this wedge pattern, you'll easily go back to the highs from 2020, which is, again, just above $2,000 an ounce, and then continue up. And really, I'm looking at a potential measured move. So if you take the low here from 2018 to this high, I think once you break out, you get a kind of a replication of that move, which puts us potentially by year end, $2,700 an ounce, maybe even as high as $3,000 an ounce. So definitely bullish on the metals, most bullish on gold, as it's a clear-cut play on inflation and money printing and the inability for the Fed to ever really exit their balance sheet to their entirety and so forth.
Yeah, it makes sense. No, Gareth, one thing that I think a lot of people get confused about is timeframes. Those first trades you were looking at were short-term swing trades, maybe 2-3 week movements, timeframes. The last chart you just showed us, I think that's a longer time frame and a longer term play, correct?
Yes, that is 100% correct. So that's absolutely right. And I'm glad you brought that up, is because as a trader, right? So I have some positions that I'm looking at larger moves on over the course of, they're more based on macro factors, right? So the macro factor for gold is that, even though the Fed says they're tightening it and is going to try, inevitably, I don't believe that they ever will be able to tighten a large amount. They'll eventually have to go back to easy money policy. If you look at the US debt, they can never let interest rates go up that much. Otherwise, we go bankrupt as a country. So it's endless printing of money, essentially. So the macro, the longer term is very bullish for gold. And I think we're borderline the beginning of that next bigger move to the upside. The other charts were charts that in a bearish market, which I do believe we're in now, those are short-term bounces where, again, you could get 10 to 20% in a very short amount of time. But you have to recognize that if in a bear market, these non-profitable tech stocks that have been beaten down, they're going to have great bounces, but ultimately they're probably going to go lower.
Would you look to flip to the short side on these names that you just showed us before, or are there other short opportunities that you're looking at this point?
Yeah, it all depends on the size of the bounce and then what levels they come into. Like, if some of those, like if Squared jumped all the way back up to, $250, for instance, well, maybe not that high, but, from 130 back to 200. Yes. I mean, there's always a point where it gets so ridiculous to the upside that you would start to look at a short. In fact, just on a technical basis, it's always important to refer to the pure technicals, right? So here's your Square chart, right? We talked about this area right here is very, very big support around 130. And what you can see here is, notice these pivot lows right here, right? So you have all these pivot lows. So if you got a crazy bounce and we draw a trend line right through that, and it's right around the 200 even number, and let's just say Square kept on bouncing and bouncing and bouncing, and it went straight into that level, then yes, that would be a major technical level. You would say, okay, Square's gone up. At that point, it would be a 50% move to the upside. Let's say it happens in 2 or 3 weeks. And at that point, absolutely, you would look to pull the trigger on a short trade there.
I think that's a great example. Is there anything that you think the audience should know?
Yeah, I think in general, just, 2022 is going to be different than 2021, 2020, because the Fed is now taking the drugs essentially away from the market. So what that's going to do is it's going to create the market that is much more volatile, much more kind of convulsive, if you will. And I think people have to be ready for that type of market. It's not a market where the Fed is always going to save it on every 3 or 5% drawdown in the stock market. So you have to be ready for the bigger swings. You have to be able to stomach them. In general, that means smaller position size so they don't make your emotions go nuts and make you make the wrong decision, because that's the biggest challenge that any investor ever has, is those emotions, keeping them under control. So definitely be ready for that. And then just I would be more of a trader in this environment. Buy when things get smoked to the downside, but they're good quality companies. And then again, on big bounces, don't get too crazy. Just look to take profits and say thank you very much.
And one last question. How best to play the gold and silver bull that you see coming ahead? Would you suggest investing in mining companies or precious metals specifically?
Yeah, so I think the best thing to do there is to definitely take a kind of diversified approach. And that's what I've done. So I have some positions in GLD for gold, which is more of my trading in and out position. And then I've bought some physical gold that I've been holding for a few years. And I continue to add little bits to that physical gold. And then I also have a position in the GDX, right, which gives me that miner exposure. The miners are great because they usually go up more than gold will. So if gold goes up 5%, usually the miners are up 10 or 15%. But at the same time, if gold doesn't do what you want, those miners will get hit more. So I think a diversified approach makes a lot of sense. And again, same thing, you don't want to put all your eggs in one basket. There are lots of places to diversify, and always remember that being in cash is actually a good thing because it leaves some stuff on the sidelines that you can put to use when the markets are ready to give you an opportunity, right? So cash is a position and it can be deployed then instead of being all in. And then you're like, oh crap, this is a great opportunity, but I can't do anything about it because I'm invested already.
Or you're too heavily leveraged in one position. And
That's right.
Well, Gareth, this has been a great market update. I really appreciate your time, and hopefully I'll get you back on here in a couple months.
Yeah, I would love that, Lee. Thank you for having me and have a wonderful day.
Thanks, Gareth.